acceleration of EVs, as well as inventories normalizing for customers and dealers, we're seeing the prices come down across the globe.
Ford invested nearly $100 billion into EVs, confident they were the future. But now demand is slowing, competition is growing, and losses are piling up. Adding their ongoing quality issues only makes the situation worse. So, how did their big bet turn into a financial disaster? Let's break it down. Ford faces a financial crisis. July 24, 2024. Ford executives step onto the earnings call with tense expressions, facing investors and analysts who are clearly unhappy. The atmosphere is heavy. Ford has failed to meet Wall Street's earnings expectations, and the stock market has reacted with force. Their shares have dropped sharply.
Ford stock investors are cheering shares after Ford's new push to charge up its future was just announced,
marking the worst decline since the financial crisis of 2008. However, the biggest concern is not just the drop in stock value. Ford's debt has reached $103 billion and continues to increase. This is happening at a time when the company is already dealing with high production costs, weak vehicle sales, and rising competition. Ford's plan to expand its electric vehicle business has required a large investment, but the results are not as strong as expected. Other companies like Tesla and Chinese automakers are moving faster, while Toyota's slower approach to electric vehicles has kept it in a better position. During the call, Ford executives explain their plans to reduce costs and improve financial performance. They talk about adjusting their strategy and focusing on long-term stability. However, investors remain unsure. Many are questioning whether Ford can recover or if the company's financial situation will continue to get worse. Ford's financial troubles stem from its aggressive push into the electric vehicle market. The company has spent billions in research, development, and infrastructure to produce competitive EVs. Yet demand has not grown at the expected rate. While Tesla has dominated the EV market with superior battery technology and a well-established charging network, Chinese automakers have flooded the market with affordable alternatives, making it harder for Ford to gain traction. Compounding the issue, Ford's traditional vehicle sales have weakened. Gas-powered vehicles still account for most of Ford's revenue, but consumer demand is shifting. Hybrid models from Toyota and Honda continue to outsell Ford's EV offerings, leaving the company struggling to find its footing. At the same time, high interest rates have made car loans more expensive, discouraging potential buyers and contributing to lower than expected sales numbers. Meanwhile, Ford's debt has ballooned to a staggering $103 billion. As interest rates rise, the cost of servicing this debt increases, further straining the company's finances. Ford has attempted to offset its debt burden by cutting costs, laying off workers, and restructuring its business. However, these measures have not been enough to ease investor concerns. Investor confidence at an all-time low. With Wall Street reacting negatively to Ford's financial results, investor confidence has taken a serious hit. Shareholders are beginning to doubt Ford's ability to execute a successful EV strategy while managing its enormous debt. Many are questioning whether Ford needs to slow down its EV ambitions and refocus on profitability. During the earnings call, Ford's executives attempt to reassure investors, outlining plans for cost reductions and restructuring. However, the responses seem vague, and analysts remain skeptical. The auto industry is undergoing rapid change, and Ford appears to be struggling to keep up. The challenge now is finding a way to regain investor trust. Ford needs to prove that its EV strategy can become profitable, that its debt will not spiral out of control, and that it can still compete in a changing market. Without a clear path forward, more investors may pull out, causing the company's financial situation to worsen. The crisis Ford didn't see coming. To everyone except Ford, the cause of this crisis is easy to see. Leadership prepares for a long session of tough questions and direct criticism. Investors and analysts want answers, and they are not willing to accept vague responses. A Morgan Stanley analyst speaks up, not holding back. You said Ford is a different company from what it was 3 years ago, but the stock market clearly doesn't agree with you. The room goes silent. Ford's leadership does not seem to have a response. After a long pause and repeated criticism, CEO Jim Farley finally speaks. The EV journey has been humbling, he says, his tone acknowledging the mistakes made. But words alone will not fix the situation. Ford had committed $100 billion to electric vehicles, believing this was the future of the industry. They spent heavily on research, factories, and new technology. But today, that decision does not look like a success. Demand for Ford's EVs is weaker than expected, competition is stronger than ever, and the company is now being forced to slow down. But this crisis is not only about electric vehicles. Ford is struggling on multiple levels.
And yet Ford outspent them in much of R&D, research and development, in the past couple of years. Where has that gone?
The company's production costs remain high, supply chain issues continue, and traditional automakers like Toyota and Honda are still leading in overall reliability and sales. Meanwhile, Tesla and Chinese EV makers like BYD have moved ahead in the electric vehicle market, offering better technology at lower prices. Ford's attempt to compete has resulted in high losses without strong returns. Now, Ford is making adjustments. They are scaling back EV investments, focusing more on hybrid models, and trying to improve profitability in their gasoline and commercial vehicle segments. However, these changes will take time, and investors are still not convinced. The company must prove that it can recover, or its financial troubles will only get worse. The illusion of growth. At first glance, Ford does not seem to be in trouble. In fact, their revenue has been increasing at an impressive rate. When the pandemic hit in 2020, their revenue dropped sharply, falling by more than 50% compared to the previous year. But after that, the company started to recover. Their annual revenue grew from $127 billion in 2020 to $137 billion in 2021, then $158 billion in 2022, and finally reached $176 billion in 2023. In a highly competitive industry like automotive manufacturing, such growth is rare and appears to be a strong sign of success. However, revenue alone does not show the full picture. Ford's profits tell a much different story. During the pandemic, the company faced serious losses, but in 2023, their operating income recovered. At first, this gave investors hope. Then, as more financial reports came in, they became cautious. Eventually, they became deeply concerned. Despite increasing revenue, Ford's profits were declining, and the numbers kept getting worse every quarter. By the end of 2023, their financial data revealed a pattern of shrinking earnings, pushing Ford down the S&P 500 rankings. They landed in 494th place, dangerously close to dropping off the list entirely. This was not a minor setback. A company can increase revenue, but if profits do not grow with it, something is fundamentally wrong. But what? Ford was spending more and earning less. Their aggressive push into electric vehicles, high production costs, and rising debt were creating serious financial pressure. Meanwhile, competition from Tesla and Chinese automakers was making it even harder for Ford to establish itself in the EV market. Traditional rivals were also proving to be more financially stable as they focused on maintaining profit margins instead of rapid expansion. Ford's leadership now faces a difficult challenge. They need to find a way to cut costs, manage debt, and regain investor confidence, all while keeping up with the transition to electric vehicles. If they fail to turn things around soon, the company's position in the industry could weaken even further. The weight of debt. Then there is Ford's debt. By 2023, their total debt had reached nearly $150 billion, creating a serious financial burden. Their debt-to-equity ratio had climbed to 2.2, meaning Ford's debt was more than twice the value of its shareholder equity. But the situation did not stop there. By 2024, the DE ratio had surged to 3.59. Understanding how serious this is helps Ford compare itself to other major automakers. The industry average DE ratio for car manufacturers is around 1.01, BMW, a company known for its premium vehicles, had a ratio of 1.1 sin. Toyota, one of the most stable and profitable automakers, had an even lower ratio of just 0.6. Ford's numbers, in contrast, indicate that they are relying heavily on borrowed money to keep operations running. What makes this situation even worse is that it is not a recent problem. Ford had a DE ratio of 3 back in 2019, meaning they were already carrying a dangerously high level of debt before the pandemic. They managed to bring it down temporarily in 2021, but the relief did not last. Debt levels started rising again, and in 2023 alone, Ford's total debt jumped by $10 billion. This shows that the company has been struggling to control its financial situation for years. Despite these financial problems, Ford is still one of the strongest brands in the automotive industry. The Ford F-Series has been the best-selling vehicle in America for 40 consecutive years, proving that customer demand remains high. Their trucks and SUVs continue to dominate in key markets, and Ford's presence in commercial vehicles remains strong. However, strong sales alone are not enough to fix the company's financial troubles. High production costs, expensive investments in electric vehicles, and rising interest rates have made debt management more difficult. If Ford does not take serious steps to reduce its debt and improve profitability, they could face even greater financial challenges in the future. The EV gamble. One major factor behind Ford's struggles: their aggressive push into electric vehicles. Ironically, things started off well. In the 2010s, Ford was interested in the EV market, but moved cautiously. They experimented with hybrid models and small-scale electric projects, but never made a full commitment. That changed in 2017, when Ford launched a dedicated EV research group called Team Edison.
To the masses as well, Ford Motor Company just unveiled their new electric vehicle series.
This team's mission was to develop a fully electric SUV by 2020, marking the company's first serious attempt to compete with Tesla. Then, in November 2019, Ford introduced the Mustang Mach-E, their first major electric vehicle. The launch event was bold and flashy, designed to make a statement. It felt more like a high-tech product reveal than a typical car announcement, with sleek visuals and big promises about the future of Ford's EV lineup. The Mach-E was meant to prove that Ford could transition into the electric era without losing its brand identity. But the Mach-E was just the beginning. Ford had even bigger plans. In 2021, they doubled down on EVs with the announcement of the all-electric F-150 Lightning. This was a huge moment for the company. The F-Series was already America's best-selling vehicle, so an electric version had the potential to dominate the market. The demand was overwhelming at first. Ford had to close reservations after receiving 200,000 pre-orders. Encouraged by this early success, Ford made a bold decision. They would go all in on electric vehicles. By 2022, they committed $50 billion to EV development, with plans to invest even more over the next decade. They set aggressive production goals, aiming to build 600,000 EVs annually by the end of 2023 and 2 million per year by 2026. This was a massive shift in strategy. However, the excitement did not last. As 2023 went on, cracks started to appear. EV sales were growing, but not as fast as Ford expected. Supply chain issues, battery costs, and charging infrastructure challenges made production more expensive than planned. Meanwhile, Tesla kept cutting prices, making it harder for Ford to compete. Chinese EV makers were also entering the market, offering cheaper alternatives. By late 2023, it became clear that Ford's EV bet was not paying off as expected. The company had to delay its production targets and scale back some of its investments. Even worse, their traditional gas-powered vehicles were still the main source of profit, while EVs were becoming a financial burden. Ford had hoped EVs would secure their future, but instead, they were draining resources and pushing the company into deeper financial trouble. The master plan, the F-150 Lightning. While Tesla and other EV makers were designing futuristic, radically different cars, Ford took a different approach. They decided to build on their biggest strength, The Ford F-Series had been America's best-selling vehicle for over 40 years, and Ford saw no reason to change a winning formula. Instead of creating a brand new design, they stuck with what their customers already trusted. In May 2021, Ford revealed their game changer, the F-150 Lightning.
Who believe in this truck so much that they're going to purchase one themselves and they're going to be able to build their own truck. Pretty cool.
Unlike the sleek, spaceship-like Teslas or the futuristic Rivians, the Lightning looked like a regular F-150, just electric. That was the entire appeal. It had the same tough design, familiar controls, and the capabilities truck owners needed, but without the gas engine. Ford knew their audience, and this strategy worked. The F-150 Lightning quickly became the best-selling electric pickup truck in the US. By 2022, Ford was the second largest EV seller in the country, trailing only Tesla. The demand was massive. Pre-orders for the F-150 Lightning hit 200,000 before Ford even started production. The company had to invest heavily in expanding its production capacity. In early 2022, they doubled their output targets, aiming to build 150,000 units a year. They also made major investments in battery technology, supply chains, and dedicated EV factories. Everything seemed to be going in the right direction. But beneath the surface, Ford's financial situation was getting worse. The high production costs of EVs were eating into profits. Unlike Tesla, which had optimized its production processes over years, Ford was still adjusting. Battery costs remained high, and supply chain disruptions made things even more expensive. Ford was spending billions to scale its EV business, but the returns weren't coming fast enough. In late 2023, the cracks widened. Tesla, Ford's biggest competitor, slashed prices on its EVs multiple times to stay ahead in the market. This forced Ford to lower prices on the F-150 Lightning, squeezing their already thin profit margins. At the same time, Chinese EV makers were producing cheaper electric vehicles, intensifying the competition. Ford's big EV gamble had turned into a financial drain. The company was burning through cash, and their debt was piling up. Even though they had successful models like the Mach-E and F-150 Lightning, their EV division was losing billions. By 2024, Ford admitted they had to slow down their EV expansion. Production targets were reduced, and planned investments were reconsidered. Now, the question isn't just whether Ford can win the EV race, it's whether they can survive it. Success or a money pit? The Mustang Mach-E was performing even better than the F-150 Lightning, so how could Ford possibly be in trouble? On the surface, they seemed to be making solid progress in the EV market. They were the second largest EV seller in the US. Their lineup was expanding, and their vehicles were gaining recognition. But a closer look at the numbers tells a different story. In 2023, the Mach-E sold over 40,000 units, marking a modest 3% increase from the previous year. The F-150 Lightning fared even better in terms of growth, with sales rising 18% to over 15,000 units. That sounds promising until you compare it to the bigger picture. Ford's official sales report for the year showed total vehicle sales approaching 2 million, with EVs contributing only 64,000 units. That means EVs accounted for just 3.2% of their total sales. While these numbers suggest that Ford was making progress, the financial side of things painted a different picture. Producing EVs was expensive, and Ford was struggling to make a profit from them. Their Model E division, which handled EVs, reported billions in losses. High production costs, supply chain challenges, and aggressive price cuts to stay competitive were all eating into their margins. Despite the excitement around their EVs, Ford was pouring more money into the business than it was getting back. At the same time, demand for EVs wasn't growing as fast as expected. Many consumers were still hesitant to make the switch due to high prices, limited charging infrastructure, and concerns over battery range. Even though Ford had some of the best-selling EVs in the country, their impact on the company's overall financial health was far from positive. EVs were supposed to be the future, but for Ford, they were quickly becoming a financial burden. Billions invested, billions lost. Ford poured $11.4 billion into 2 battery plants.
Monday's announcement is the single largest manufacturing investment in Ford's 118-year history.
Invested another $1.8 billion in Canada for EV manufacturing and committed €2 billion to an EV facility in Germany. And that's just scratching the surface. In 2022 alone, Ford pledged a staggering $50 billion solely for EV development. The scale of these investments showed how serious they were about electrification, but it also revealed the enormous financial risks they were taking. The problem? EVs aren't just another line of vehicles. They require entirely new manufacturing plants, specialized battery production facilities, and a restructured supply chain. These aren't minor adjustments. They're fundamental shifts in how cars are built and sold. The tens of billions of dollars Ford has sunk into EVs have been supporting only a tiny fraction of their actual revenue. While Ford's gas-powered vehicles continue to drive most of their sales, the company was pouring money into a sector that was growing slower than expected. The assumption was that this was all part of a long-term strategy, that the EV market would continue growing at a rapid pace. But the landscape shifted drastically. Battery costs remained high, charging infrastructure struggled to keep up, and consumer demand for EVs didn't meet industry forecasts. Competing with Tesla, Rivian, and legacy automakers, all racing toward electrification, made profitability even harder. Instead of a smooth transition, Ford found itself burning cash at an alarming rate, with no clear timeline on when or if these investments would start paying off. Tesla's price war. In 2022, a brutal price war began as Tesla slashed prices to compete with emerging EV manufacturers in China. The price of the Model 3 was cut by 6%, and the Model Y saw an 11% drop. These reductions were necessary to compete with the growing dominance of BYD, a Chinese EV giant offering significantly cheaper alternatives. Since Tesla leads the EV market, their price cuts forced others, including Ford, to follow suit. Ford found itself in an unfortunate position, compelled to slash the price of the F-150 Lightning by as much as $7,000. Meanwhile, material costs were soaring, and supply chain constraints were tightening, making it increasingly difficult to produce EVs profitably. Ford was up against an entire wave of low-cost EV makers from China, whose aggressive pricing strategies were redefining the market. By the first quarter of 2024, Ford's EV unit reported staggering losses of $1.3 billion. This meant that for every EV Ford produced, they were losing $130,000. To make matters worse, it wasn't just production costs eating away at profits. Demand was shifting as rising interest rates made car loans more expensive, discouraging potential buyers. Government incentives that had previously fueled EV adoption were also beginning to phase out, removing a crucial safety net for companies like Ford. The result? A rapidly growing EV sector that was becoming more competitive, less profitable, and increasingly risky for traditional automakers trying to keep up. Governments pulling the plug. For years, the EV industry had been propped up by government incentives and subsidies, but that support was beginning to crumble. In December 2023, Germany ended its EV subsidy program, setting off a chain reaction. Soon after, New Zealand, France, and Sweden followed suit. Even in the US, political uncertainty loomed, with Trump vowing to roll back EV incentives if elected. These subsidies had played a crucial role in making EVs more affordable for consumers and financially viable for automakers. Without them, the cost burden shifted back to companies like Ford, which was already struggling to turn a profit. At the same time, competition in the EV space was reaching an all-time high. Legacy automakers, startups, and Chinese manufacturers were flooding the market with new models, each trying to undercut the other on price. Ford had banked on strong EV demand continuing, but with rising interest rates and economic uncertainty, many consumers were hesitant to make the switch. With the market becoming increasingly crowded and unprofitable, Ford started to realize that their EV bet was becoming a liability. The EV retreat. Ford officially cancelled an upcoming EV SUV, and wrote down most of its EV investments as losses. For the full year of 2024, Ford's EV division reported a devastating $5 billion loss and projected the same for 2025. In their latest earnings call, Ford executives revealed they were slashing EV spending from 40% to 30% and scaling back production of the F-150 Lightning. The message was clear. Ford was no longer willing to burn billions chasing an uncertain EV future. It's a stunning reversal for a company that had once bet everything on EVs. Just a few years ago, they were racing to establish themselves as Tesla's biggest competitor. Now, they were stepping back, forced to face the harsh financial reality of their aggressive push into electric vehicles. While the Mach-E and F-150 Lightning had shown promise, they weren't enough to offset the enormous costs and shrinking profits that came with EV production. Everyone was convinced that EVs were the future. Every major car manufacturer jumped headfirst into the race, determined to secure their place in the electric revolution. But now, that certainty has crumbled. EV sales growth is slowing, price wars are intensifying, and government support is fading. Ford's EV struggles have been making headlines, but the real crisis, it's not just about electric vehicles. There's a much bigger problem straining Ford's business, and somehow it's even worse than the EV disaster. Ford's quality control nightmare. Despite holding the top spot for the most sold car in America, Ford has had an ongoing battle with consistency. They simply can't seem to get their quality control in order. And the result? A never-ending cycle of cars leaving the factory only to come right back. The sheer volume of recalls over the years has left customers frustrated and Ford's reputation in question. Back in 2020, Ford recalled over 700,000 vehicles due to faulty rear-view cameras that would suddenly shut off.
Thousands of vehicles. The automaker is recalling 700,000 vehicles for faulty backup cameras.
Sounds bad, right? Well, that was nothing compared to what came next. Fast forward to 2024, and Ford issued a jaw-dropping 37 different recalls. That included 2 million Ford Explorers and nearly 800,000 other models, all due to electrical issues. These defects posed serious safety risks, forcing Ford to scramble for solutions while dealing with public backlash. And it only gets worse. That same year, Ford was slapped with a $165 million fine from the US government for not only recalling vehicles too slowly, but also providing inaccurate information about the defects. This was a sign of deeper issues within Ford's manufacturing and regulatory processes. The cost of their mistakes has been stacking up for years. Back in 2014, Ford spent $4.8 billion on warranty expenses, already a massive number. But by 2023, that figure had ballooned to an eye-watering $11.5 billion. And with recall after recall adding to the pile, Ford's financial burden keeps growing. With no clear end in sight, investors have had enough. Ford's repair costs have also surged, growing by an additional $2 billion in just a few years. What was once a manageable issue has now become a major financial burden. Investors are losing patience, and it's easy to see why. In the Q2 2024 earnings call, an analyst bluntly asked Ford's leadership, how can investors really build confidence in an earnings trajectory when every year the surprise warranty issues keep happening? The frustration was clear. Ford's quality control failures weren't just hurting customers, but also those betting on the company's future. Ford's CEO, Jim Farley, scrambled for an answer, insisting that improving quality was the company's #1 priority. But investors aren't buying it. Ford's price-to-earnings ratio currently sits at a shockingly low 6.32, a clear sign that confidence in the company is dwindling. Compared to competitors like Toyota and General Motors, Ford is struggling to convince the market that they have things under control. The numbers paint an even grimmer picture. In just one quarter, Ford spent $2.3 billion on recalls and warranty claims. That breaks down to about $25.5 million per day. Money that could have been used for innovation, expansion, or simply improving profitability. But here's the kicker. It's not even the Ford F-Series trucks causing most of the issues. The real problem lies with their newer models. particularly those equipped with the latest technology and electronic components. Instead of moving Ford forward, these models are draining resources and making their quality control crisis even harder to fix. A pattern of failure. Ford has a bad habit of launching new models with more defects than the industry average. When a new vehicle is introduced, Ford's defect rate spikes by 70%. To put that into perspective, the industry average is only a 20% increase. That's not just a small hiccup, it's a massive failure in quality control. Something is seriously wrong with how Ford is developing and testing its vehicles before they hit the market. Instead of refining their process, they seem stuck in a cycle of rushing new models out the door, only to spend billions fixing the problems later. It's a strange contradiction. On one hand, Ford looks like it's thriving. Sales are strong, and they're still a dominant force in the auto industry. But beneath the surface, it's a financial nightmare. The company is bleeding billions, losing investor confidence, and struggling to keep up with a rapidly changing market. And the most concerning part, there's no easy fix. Cutting EV spending won't solve their recall crisis, and improving quality won't instantly stop the financial losses. Ford is running out of room to maneuver, and if they don't figure out a solution soon, their position in the industry might not be as secure as it seems. The EV gamble that backfired. As if Ford's quality control issues weren't bad enough, they've also found themselves trapped in the EV game. They poured tens of billions of dollars into EV factories and battery plants, all to manufacture vehicles that aren't turning a profit. The industry once seemed like a golden opportunity, but now it's become an anchor dragging Ford down. With each passing quarter, the losses keep stacking up, and the hope that EVs would eventually balance the scales is fading fast. For years, Ford believed EVs were the key to their long-term survival. But while they focused on the future, they neglected the cracks forming in their foundation. Their core business, trucks and SUVs, remains profitable, but even that is under pressure from rising competition, supply chain challenges, and shifting consumer demand. Now, the company faces a harsh reality. EVs aren't the easy moneymaker they hoped for. Their traditional vehicles are struggling with quality issues, and their overall financial health is hanging by a thread. If Ford doesn't course correct soon, their position in the industry could be at serious risk. Ford's uncertain future. Fixing their quality control issues should be priority number one. If they don't, their brand reputation will continue to erode, and they'll be drowning in warranty costs for years to come. Recalls, repair expenses, and customer dissatisfaction are piling up, and if Ford doesn't act fast, they risk losing even more market share to competitors with better reliability. Ford is one of the few American car manufacturers that has never gone bankrupt, but even that history isn't a guarantee for the future. With EV losses mounting, warranty costs skyrocketing, and investor confidence shrinking, the company is running out of room for mistakes. The question isn't just whether they'll fix their problems. The real question is, how much longer can they survive without doing so? Ford's future hinges on the decisions they make now. The auto industry is evolving fast, and while innovation is key, it means nothing without a solid foundation. If they can't get their quality under control and turn their EV strategy around, they'll be left behind by competitors who can. Can they fix their quality issues before it's too late? Will their EV investments ever pay off, or are they digging an even deeper hole? Let us know what you think.